David Roche, strategist at Quantum Strategy, with us this morning. David, great to have you on, as always. In light of everything, I'm going to start with the Fed meet, actually, because closest here, something that all of us are watching very closely. What are you expecting?
Oh, I think they'll cut rates by 25 basis points. It's probably not that justified by the economy, but I think we have to look at the politicization of the Fed now and down the road. So it seems to me they're going to have regard for not getting into an even worse conflict with the president about the independence of the Federal Reserve Board. So the best way out for them is to take the data which is on the labor markets, which shows things as being a little weak, and ignore everything else, which shows the U.S. economy as being relatively strong, and then cut rates 25 basis points. That's my view.
David, morning. Alex here. I'm just wondering
Morning.
I don't know if you heard the entire conversation we were having about the yen carry trade. And what do you think about that? With the fiscal policy likely to bolster growth, does that ease the tension of a yen carry trade unwinding?
I don't think so for very long. Look, again, we're looking at a conflict here between what the government wants to do fiscally, which entails spending a lot of money, and what the central bank wants to do, which is to normalize monetary policy. And those two objectives come into conflict with each other, with the Prime Minister, of course, wanting lower rates, and the Bank of Japan wanting tighter rates to try and get things back to a normal setting for monetary policy. Now, what the JGBs are telling you, pushing 2% on yields, is that if the rates are not raised, then the assumptions about higher, longer-term inflation are going to continue to go up, and the result will be that Japanese JGB yields at 10 years will probably join those of Germany at around 2.5 to 2.7%, which of course will undo all the effects of this fiscal stimulus which is coming along. So I listened to your conversation, and I think the three of you got it more or less right, not by being particularly decisive about which way it's going to go, but about saying this is going to be very volatile and it's going to be very contradictory. So I would have thought the big thing here is the contradiction between Japanese BOJ monetary policy and government fiscal policy. And I don't think that's not going to go away. That's going to be a huge theme.
David, with the presumption that you look at India as well close enough, the FPI positioning in India is at whatever multi-quarter lows. If indeed the rate hikes in BOJ are a bit more measured and it doesn't lead to a dramatic yen carry trade unwind positioning happening, could it be the case that India will not get impacted too badly because of the outflows? Because frankly, all of 2025, what we've seen from Indian markets is FPI outflows.
Well, look, I think the question, there are two real questions in here, is how much is the Bank of Japan going to raise rates? And the answer is, by a tiny amount. This is not going to be a waterfall event for the yen carry trade. But if you go forward looking at Japan, I think the normalization of monetary policy will progressively reduce the yen carry trade. But this is about hedge funds and people who borrow yen. It is not about, as the market sometimes believes, Japanese investors like insurance companies repatriating all their foreign assets. That's just not going to happen. They may hedge more of them, but they're not going to take them all home. That's not feasible, and it's not going to happen. So I would view this as less of a dramatic event than the market sometimes anticipate. What I do think, however, is the most dramatic event that's going to affect Japan is the blatant contradiction between a very large fiscal package of 3-4% of GDP, which is going to push the fiscal deficit up yet again in an economy which has got 250% of GDP in sovereign debt, while the Bank of Japan is going to be struggling to contain the monetary effects of such a stimulus policy, which entails tightening rates. But that's going to be the long run story, which we will be discussing for the whole of next year.
Absolutely. David, on that note, thanks so much for taking the time. Pleasure speaking with you this morning.